Hi, everyone. Today we're comparing stocks versus real estate. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit the subscribe button and the bell notification so you don't miss a thing. I'm Elliott, and today I'm joined by Brian and Will. Okay, so we're going to cover a lot of topics, but first let's just start with raw land. So Brian, how do you think about raw land as an investment?
Well, with raw land, this is the idea of just buying up a piece of acreage and then just sitting on it. In many ways, it's kind of been similar to something like gold that's just maintained its value and at least kept pace with inflation. But in fact, it's actually done a little bit better over long periods of time, simply because as we urbanize, there's only so much land. And as we urbanize and become more crowded in an area, it creates a scarcity of land relative to the demand. And so it's led to, over long periods of time, about a 1% real rate of return. But I want to point out that's different than, when the distinction between people saying, well, what about developing raw land? That's a whole different business venture where you're not just buying and holding a piece of raw land. You're actually going through tax laws and building out utilities and whatnot. And that can end up potentially being very profitable if you pick the right land. It could also be a disaster if you try to develop it in the wrong place and it didn't work out like you thought.
Yeah, I agree. Yeah, many great fortunes have been made from development, but also many have been lost. It takes a real risk-friendly person to do that. Will, let's move on now to buildings that have already been built, that people are managing for cash flow. How do you think about commercial real estate and then also residential real estate?
Sure. So, when you're looking at commercial real estate and residential real estate, from a return standpoint, they've been fairly good. But so little data is actually known because most of the commercial and residential real estate deals are private, and that information just isn't very easily accessible. And so what you end up doing is you kind of look at a broad index, like a real estate investment trust, and you look at that broad index, and even when you look there, the returns have been actually very comparable to stock returns in the long term.
But is there any downside to that? What do you think, Brian? Are there any risks to real estate?
Well, sure. So as Will says, they were comparable returns. I think the important thing to point out is that was done with a lot more leverage.
Right.
So, real estate in general, by definition, real estate costs a lot. It's a very capital intensive, requires a lot of money to buy the asset. And so in order to make a high return as an equity holder, you naturally end up borrowing a lot from someone else, usually the bank, to be able to leverage up, 60 to 70, maybe 80% loan to value ratios. And inherently, that leverage makes it more risky. And especially more so when you compare it to, say, the portfolio of businesses that we tend to own. Many of the businesses we own, those stocks tend to be net cash or very low leverage, yet have produced comparable returns. And so by definition, we would view that as much less risky. And also I'd point out that many of those businesses, they sell small dollar products that oftentimes tend to continue to be consumed in many different types of economic scenarios, which provides a lot of comfort that the cash flow will continue regardless of what's going on in the economy.
Yeah, that great point, Brian. And it makes me think of this book I read called The Great Depression Diary. And it's this guy who was a lawyer in a small town, and he was kind of looking at the Great Depression and evaluating everything around him. And he discussed how things got so bad in the Great Depression that people were actually burning down their houses and commercial office buildings, commercial real estate buildings, just to be able to afford the property taxes. And, that's contrasted a lot with some of the businesses we own, which were around even then, such as like Procter & Gamble and Unilever, which sold these basic goods and certainly was a difficult time for them, but they were able to get through it.
Yeah, that's incredible. It's crazy.
Yeah. And I
I'll make the other point, Elliott, I think as well, when people think about real estate investing, I think it's very localized, right? So I think for a lot of people, they look at a real estate deal or an opportunity in their local town, and they like the fact that they can feel and touch the building. It's there. They can see it. They can, find a tenant, receive a monthly check, and that's very attractive to a lot of people from a real estate investment standpoint. But I think that also creates some risks, and actually 3 risks that I can think about. So one, I think it's liquidity. 2, a diversification problem. And third is just the lack of information that I mentioned, earlier on.
Yeah, great point, Will. Yeah, I feel like a lot of people, what they want is they want that kind of tangible thing they can drive by and be like, I own this. But the problem with that is, it's very, very hard in a lot of cases to sell those big properties when, and especially in really bad down markets. You pay a huge premium. Just think about, even with your house, it costs 6% to sell your house. So I think that's a big risk.
And so not just the liquidity issue and that spread, but also diversification. I mean, if all you do is own a single building, imagine if the building you pick happens to be a city that's performed poorly. Like you own a single building in Detroit with one tenant. Now contrast that revenue source from the diversification that comes from owning a business like Procter & Gamble or like Colgate, where they're selling businesses. Not only is it that they have multiple billion-dollar business lines of different product lines, but they're also selling in like 200 different countries around the world. So there's a currency diversification, there's a product line diversification. And then you can get a portfolio of all of these global champions. So diversification is a strong suit, I guess, and very easy to do with a collection of stocks.
Yeah, a great point. And I'd also mention, I've had several acquaintances and friends who've done real estate deals, and they've gone into the deal thinking that, certain parameters were going to happen to unlock this value from the real estate deal. And then things haven't worked out the way that they had hoped. And so again, that lack of information and data and just the different variables can dramatically create a different return than you were hoping for from that real estate deal.
And in addition to just these 3 risks we've talked about, I just throw out there's no headache, right? I mean, nobody calls me in the middle of the night about my portfolio, but they certainly would if it's about my piece of real estate that's a leaky faucet. And so that's, I think, why there's that saying that real estate takes the passive out of passive income. There's just a lot of headache and sweat equity that can go into that.
And that's not to say, real estate can't be profitable, right? You can make, and obviously people have made a lot of money in real estate. And I think probably for us, if you're going to want exposure in that area, you could do it through a REIT, a real estate investment trust, where you have that broad diversification. I would just say, do your homework before investing in a REIT, because there are obviously fees, and there's a manager there, so you got to do some due diligence on what the expertise of that manager is. So you got to do your homework before investing in a REIT. But that's probably a way to diversify that concentrated risk. Just investing in one real estate deal in your hometown or something like that.
And I would just point out that don't forget that many people are already very invested in real estate, and most people, it's actually their biggest asset through their home.
Yeah, great point.
And so I think that's another important thing that we really need to keep in mind as we think about ways to diversify our portfolio into many different types of assets that can perform well over time. And of course, it's a really good thing that people have invested in their home, because the government gives you lots of tax breaks and things, which, Brian, I don't know if you want to go into some of those.
Well, just that, you get your interest tax deduction. They basically subsidize your ownership by allowing you to deduct your interest expense. You can deduct property taxes, only up though to $10,000 now as a cap in current times. If you're switching around real estate properties, you can do 1031 exchanges. So there are some positive things for sure that exist within real estate and investing. And I would say that it does force, for most people, it becomes a forced saving mechanism. So many people who would maybe not save, by making their monthly mortgage payments, they're naturally socking away money that's getting put towards equity month after month. So that's positive. But there's definitely some downsides. The property taxes, the maintenance, And yeah, I would point out also just the emotional one. So if you think about the difference between managing a property for cash flow and then living in a home, we tend to, if we're managing a property for cash flow and we're thinking about what upgrades to put in, what quality of, kitchen counter, those sorts of things, we do a very, cash flow analysis of that. But if it's your home, it really bleeds into like a lot of emotional kind of feathering the nest type things that lead to upgrades and things that really kind of erode that return over time and make houses much more of a consumption item in many cases than really an investment item. And I know, Brian, you wanted to talk about just kind of the difference between, a mortgage and renting and how to think about those things. Yeah. And I was just gonna say though, to your point though, it's like America's largest money pit. I can definitely attest to that.
Isn't there a movie about that?
Yeah, we have.
So, but yeah, I wanted to bring up just say, imagine running this scenario that, suppose that you could say, on the one hand, I'm gonna rent a property. On the other hand, I'm going to buy it and mortgage it. If you were to buy the property and mortgage it, if you just sat in this home for 30 years, at the end of the 30-year mortgage, you'd end up owning the home. And as based on what we were saying, it basically would act a lot like raw land in that sense because it wasn't cash flowing. The value of the property would basically be probably what you bought it at, plus inflation, maybe inflation plus 1% over that time frame. But then, of course, subtract maintenance, capital expenditures, property taxes. But in general, my point is that it's going to be, it'll rise in value for sure, but by about the amount of inflation or inflation plus 1. Now take the scenario where you rent. If you can assume that in that rental situation that instead of putting money towards a down payment, you took the money and you put it towards a collection of businesses and then compounded at, equity-like index returns or a portfolio of global champions, that portfolio would come out being multiples more in value than the value of the home. So of course it depends on certain scenarios, but I guess what I'm trying to point out is a lot of times people think, oh man, rentals are terrible because you're just giving money to someone else. But actually by renting a property, many times it actually can become more profitable for you because you're able to take that down payment, invest it in cash flowing businesses. Whereas with the home, all of your payments are being stuck and forced to be inside that house, only growing at inflation.
Yeah, and that's a great point. I'd counter though to that. Most people, probably stay in a house on average maybe 5 years, and especially in an interest rate environment right now, you have the opportunity to kind of refinance, take advantage of lower rates, and take out equity out of your home, and then probably invest that in the stock market or other asset classes. But your simplistic example is a very good one. I think that teaches us great lessons about how to think about your capital and what are the best ways to generate a rate of return adjusting for risk. So I think there's a lot to think about there. Yeah.
So essentially just kind of summing up, we think both categories, real estate, especially through a broad index such as a REIT, and then also stocks are great choices for investing. But we strongly prefer stocks because not only do you get the comparable returns, but we believe you're taking on a lot less risk because it takes a lot less leverage to do that. And especially in a catastrophic downside economic scenario, we think that's an important consideration. So anyway, thanks so much for watching. We really appreciate it. And we'll see you next time.